want to make our way into fixed income. We talked about this a lot. One of the bigger stories here has been the behavior of rates. So let's begin there.
Yeah, maybe the opposite of what Nelson was saying, like the whipping boy for the first 6 months has really been fixed income, right, in a lot of ways. And part of that's driven by the dynamic in AI and what it means for growth. And part of it is driven by the inflation outcome, which Eric touched upon, as oil prices have undulated between 60 and 100 and back down. But the result of all that is really twofold. Number one, on the left, right, yields are higher. This is not just a U.S. phenomenon, right? Yields are really higher across the board. And the reason being on the right, or one reason being on the right, is that the market has gone from pricing in more monetary easing, right? So here we show the number of rate cuts expected by the market for the U.S., Europe, and England, and the U.K., right? We got the FIFA England in there, right? And what you really start to see is, right, the market is now pricing in rate hikes, and we've actually had some of those hikes realized, right, in places like Korea last night, in places like Europe, right, a couple of weeks back. And if you look at the next page, really, like what's happened is all of the move has really happened in real yields. So what does that mean? If you look at inflation expectations have been remarkably stable, right, as measured by, by TIPS as an example, right, at about 2.3, 2.4. And so all of this tightening is really happening in that real yield component, which for me, right, is telling us that the market is really worried that we are moving to a higher trend growth type of environment, right, potentially driven by AI and the productivity enhancements that may come from that. And agreeing with Nelson, right, it's probably too early to make that call. I think what's interesting on the right is that the curves have flat, right? And for me, in my market history, anytime someone talks about monetary policy being too loose, right, loose policy typically yield curve steepen, right? Tight policy yield curves typically flat. Right, so if anything, the yield curve, which is one of the best predictors in markets, right, is telling you that monetary policy is not as, it does not need to tighten further, right, from here. So as Eric touched upon, we're going to push back against this market pricing of rate increases. So what that means is, look, we think there is an opportunity in duration, right, on the next page, Rick, right? So on the left, there's a pretty big gap that's opened up between oil prices and treasuries. Right, we've gotten that oil dip back down, but treasuries really haven't moved much. In the middle is what I just talked about. Inflation expectations, that's not the problem, right? I mean, Eric's talked repeatedly about, if the Fed gets nervous, it's when inflation expectations start to become unanchored. The TIPS market, as a measure, tells you everything is pretty hunky-dory, whether you look at 5-year, 10-year, right, 30-year out, right, out the curve. So for us, right, policy could stay stable, and we think we could get some further rally in the front end, right, of the market.
And think about it this way. I mean, look, in the fixed income world, we get excited about a few basis points, so I have to call the scale out here. If you look in the middle, it looks like a big move. That's 40 basis points, 50 basis points you're talking about. So this is staying within a contained space. And for those of you looking, I want you to picture that blue line on the left disappears. And what I'm doing is putting oil prices up against inflation expectations. You'll see that they are very similar in how they look. And so to Scott's point, what emerges from that then is if you're looking at treasury yields in total, nominal yields, if we plotted it, you would see real yields climbing, right? That's what comes out of the subtraction, is you see real yields climbing, and real yields are the inflation-adjusted income you can earn. Translation, pay very close attention to opportunities in fixed income and why we're talking about taking duration.
Yeah, and I would think the global story, right? So I showed you a few pages back that yields are up globally. But when you think about the dynamics driving that, right, oil prices and the AI spend, there's a lot of economies or areas that are on the wrong side of that, right? Europe being a good example, right? Europe is still an energy importer, so they get hit by the higher energy prices, and they don't really have the booming AI CapEx cycle that they're seeing, right? So this is a region that we think is going to continue to struggle, right, with growth. This is a region that we think duration is attractive and will continue to become more attractive. Similar in Canada, right? It has the energy benefit, but has very little, right, on the AI front, and actually has, what we think is still reasonably tight policy, right? The same in Australia. So the takeaway from these charts is really like, look, the bond market is not a homogeneous animal, much like Nelson touched upon in the equity section. And we think we will have variation in the economic cycle because these two main drivers, energy and AI CapEx, do not uniformly hit every sector or every country the same way. So if you look at, again, we've had fairly modest returns. So it hasn't been, a great environment for treasury yields or for interest rates. You see that in the first half of the year on the right at the bottom of the chart. But if you look at some of the credit sectors, right, they've performed a bit better, right? So you've got the benefit of carry, and in many cases, you've got the benefit of, some modest spread tightening, both in the taxable space, and Matt will touch upon, right, the muni space as well. So if we think about like corporate bonds, and I want to talk about hyperscalers because they're the other side of the equation, right? If somebody has to spend more money than they're generating, they got to borrow it from somewhere, right? And that's really where the bond market comes in. But if we just start with kind of corporate bond spreads, look, spreads are tight. If you look on the right-hand chart, right, you get a sense of like all-in yields, right? What the minimum has been, what the maximum has been, and we're kind of in that turquoise teal line that you gentlemen were referring to earlier. So you get a sense that we still are kind of in the middle or higher historically in what that yield outcome has been. And look, for everyone out there, right, we can talk about spreads, but spreads are a terrible predictor of returns, right? But yields are a very good predictor of returns. So as we've seen higher yields, as we've seen, right, wider spreads in any combination, right, buyers have emerged because the income opportunity is that much greater. So let's talk about like the elephant in the room, which is really, right, the hyperscalers. And, if you look, the issuance has really been off the charts, right? Year to date, AI-related bond issuance has reached $270 billion, right? And that's $194 billion from hyperscalers, right? That's more than double what we saw last year in 2025. Amazon alone borrowed $100 billion of that, right, of that number. So, I mean, this is a ton of supply that's coming to the bond market. That supply is forcing credit spreads higher. I actually think it's forcing treasury yields higher as well, right, as the capital is moving into, this sector. I used this analogy with Rick yesterday about like this notion of like Satan's bushel, which is like the last bushel that a farmer puts on the market that breaks the price, right? I'm not sure we're there yet, right? But the more those hyperscalers issue it, like last week, right, that more issuance is eventually going to cause that pushback in the market and really rely upon wider spreads, right, wider credit spreads, right? And we have started to see that on the right with hyperscalers, which are very highly rated. You can see in the middle, right, trading at about the widest part or the widest component of the overall market.
And now let's take our way to
and
favorites.
High yield, same story, right? The blue is more important than the yellow, right? The all-in yield that you receive is more important what the spreads are, and whether your yield comes from rates or comes from spread historically hasn't mattered all that much, right? Yield is the thing you should care about. On the next page, what do you want to buy, right? I mean, Nelson touched upon this, right? Nelson and I talk a lot about picks and shovels. You don't have to pick the winner, right? You don't have to pick which LLM is gonna succeed here. But all of those companies, a lot of them in the high yield space and that small cap space, right? They're making the components, they're making the switches, they're building the pieces or the parts of the data center, right? That's what you want to own. And the high yield index, right? As a result, it's very high quality, the highest it's been in decades. The duration of high yield has, dipped below 3, which that's a shocking chart, right? And that's really a reason why we talk about high yield at lower spreads, right, than they've been historically. But again, 6.5 to 7 on high yield historically has been a pretty good level to enter the asset class.
And actually, it's just surprising. We've talked about this for years now, is that if you were going to get yields that high, it was usually because something had happened. Yields were low, treasury yields were lower, and spreads were the thing driving it. And so a lot of the times people think there's something wrong because spreads are tighter and it's treasuries producing most of that yield. But the reality is, and one big part of the reality is the changing makeup of the entire index that you alluded to. If you get higher in quality, then your spreads are supposed to get tighter. And so this is Look, this is one of those spaces that, of course, my roots are bonds, so I am biased. But this is a space that I think has a lot of interesting things to say about it, about itself. And especially now, there's opportunities inside it at a whole, at a space level, but also idiosyncratically.